But if you look at the biggest risks and you're expecting a correction, would it come from monetary policy or does it come from actually just the fact that it could be a frothy equity market?
Well, in a way, of course, it's always very difficult to know what a trigger is. All we can look for is the signs that the market is vulnerable to disappointment. I would think that a rise in interest rates beyond what the market is pricing is one of the plausible triggers because you have very little term premium priced into bond markets still. There's still a very benign forward path for interest rates priced in by the market, although now, of course, pricing in a March increase in the US. But our economists are expecting 4 rate rises this year and 4 rate rises next year. And that, if it were to come through, I think could be a surprise to all asset markets, creating something of a trigger for a correction. Probably not a bear market, but a correction.
But Peter, how can we be so sure that actually inflation is coming in the US, right? This was the big story of 2017. It's coming, it's coming, it's coming, but actually it never really quite came.
Well, I think there are 2 points here. First of all, there are some signs that inflation is coming through in parts of the economy. We've seen higher commodity prices again. Companies, some of them are talking about higher input costs. But even without higher inflation, we have to recognise that global growth is extremely strong and very well synchronised. That's a great thing. But it may require just a bit more normalisation of policy rates. Bear in mind that in the US, financial conditions are the loosest level that they've been any time through the financial crisis. So they're looser now than they were even when we had very weak growth, very unstable growth, significant uncertainty. So just to compensate for that itself, we may require some moderately high but persistently higher interest rates.